Hey guys, Rafi here from the End Game Investor, and we've got a lot to cover this week. We've got BlackRock talking about the end of the stock market. Not really, not literally, but they're sounding kind of apocalyptic, at least for BlackRock. We got Egyptians hoarding gold because their currency is collapsing. And I wanted to go into a line from Zoltan Pozsar, that monetary guy that talked about Russia accepting payments for oil and gold that could cause the gold price in dollar terms to rise to $3,600, and just get down to the bottom of what he's saying about the paper gold market. Earnings for the Federal Reserve came in on Thursday, and it's even worse than it was last week, and it will continue getting worse as rates go higher and higher. And what happens when the Fed loses money? They print money to cover those losses.
Well, it's not going to do us any good to sit here whining about it. We're in a hole. We're just going to have to dig ourselves out.
It's not just Russia that is threatening to abandon the dollar and accept payments for oil and gold. China is doing it too. This week's video is brought to you by
Fishy Joe's. Try our new extreme walrus juice. 100% fresh squeezed walrus. Ride the walrus.
This week's video is actually brought to you by Gold Mining Inc. I bet you can't guess what they do. Gold Mining Inc. trades under the symbol GLDG on NYSE American. You can see here, this is the page for the GDXJ, the Junior Miners ETF holdings, and GLDG appears on the list. The fund owns 7,057,570 shares of GLDG. So for every 400 shares of GDXJ that you own one share of GLDG. Now, if we take a look at how this stock moves, here is GLDG relative to the GDXJ fund, of which it is a part. And you can see here the GDXJ is in the candles, and GLDG is in the black line above it, most of the time above it. So generally, this stock does outperform the GDXJ, but you see they move here pretty much in tandem, as should be expected. But if we move to this chart, you can see here, going back on a one-year chart, that GLDG, Gold Mining Inc. has outperformed GDXJ pretty well. It's up 14% for the year versus the GDXJ, which is down about 11%. And what is the story with GLDG? Well, the company owns about 32 million ounces of gold underground. These are estimates. And by their market cap, that would put each ounce of gold at about $5 an ounce. Obviously, you have to pay to dig it out of the ground, but the average for gold in the ground is about $30 an ounce. So there is undervaluation here. The stock is owned by BlackRock. We'll talk more about BlackRock in a minute. Rick Rule, Doug Casey, the KCR fund, of course, the GDXJ, which we talked about in a second ago, Rougher Gold, Extra Capital, Sprott Global, Marin Katusa, and Oppenheimer Holdings. So it does have a significant amount of backers. The business model with this one is that when there is a gold rush, and there will be a gold rush, there are going to be a lot of bigger miners that are looking for projects. There will be a lot of mid-tier and larger mining companies that will be looking for projects that are licensed and ready to go and acquire them, probably at more than $5 an ounce underground. So the base case is, if mining stocks have bottomed, and I think that is a very strong possibility, then GLDG will probably outperform the GDXJ. And yes, it is a speculation, so keep that in mind. And now on with the show. We start with BlackRock and a report by Business Insider. BlackRock says, get ready for a recession unlike any other, and what worked in the past won't work now. Why won't it work now? Because the past was based on the Fed printing dollars every time there was a recession or a serious stock market crash or pullback. That can't happen anymore. Says the article, a worldwide recession is just around the corner as central banks boost borrowing costs aggressively to tame inflation. It calls inflation, obviously, they mean rising prices. And this time it will ignite more market turbulence than ever before.
Folks, we're experiencing some moderate Godzilla-related turbulence at this time, so I'm going to go ahead and ask you to put your seatbelts back on.
According to BlackRock, well, ever before, that's a lot of market turbulence to ignite. Recession is foretold.
It is known.
It is known.
It is known.
It is known.
As central banks race to try to tame rising prices. It's the opposite of past recessions. And so how is this going to be solved? According to BlackRock, of course, you're going to have to trade more and give BlackRock more commissions. How do we know that? Look at this paragraph. The prospect of limited policy support, meaning less money printing, means investors need more dynamic methods involving more frequent portfolio changes, more commissions for BlackRock. And so central banks can't support stock prices much longer or at all anymore. And so you're going to have to trade more and give BlackRock more commissions, or you can just buy gold and silver and wait out the inflationary madness.
This is madness!
Madness.
I should add that, yeah, the Fed is going to print again to support not really the stock market, but the bond market, because when the bond market collapses, the entire banking system, which is built on bond prices because they're all stuffed with bonds to the gills and beyond, the entire banking system collapses. So the Fed does have to print money, and it does support equities in a nominal sense. But once that final printing takes place, the purchasing power of the dollar is going to fall through the floor. So it won't matter what stock prices are anymore, because you won't be able to buy anything with the dollars in which they are denominated. What will you be able to buy things with? Gold and silver. How does that work? We'll see. But every time there is a monetary crisis, that is what happens. Humanity goes to gold, as is what is happening in Egypt right now. Let's go to the next slide. Egypt, gold buying mania as national currency loses value. Many want to protect their saving by hoarding gold, but that has led to an exponential rise in the price of metal, making it off limits for other consumers. So what should you do then? You should buy silver, of course. This is the Credit Suisse paper by Zoltan Pozsar, which has been making the rounds on the internet these days among the gold and silver bugs. This is where he makes the case that Russia can accept payment for its oil in gold terms and destroy the dollar, bringing the gold price up to about $3,600 an ounce. Here's where he explains how it can be done. Here, I'm going to highlight it. But if the West is looking for a bargain, Russia can give one the West can't refuse, a gram for more. If Russia countered the price peg of $60 with offering 2 barrels of oil at the peg of for a gram of gold, gold prices double. The most important, gold going from $1,800 to close to $3,600 would increase the value of Russia's gold reserves and its gold output at home and in a range of countries in Africa. Crazy? Yes. Improbable? No. Let me just put this in simpler terms. If Russia offers more oil for less gold, it raises the gold price in dollar terms. Because if you're getting more oil for less gold, then people take their dollars to buy the gold to get more oil, and the arbitrage between dollars and gold doubles, so that the arbitrage in oil no longer exists. And what happens when the gold price doubles in dollar terms? That halves the purchasing power of dollars across the world for everything. It collapses the entire bubble. Why is that? Why would Russia offer more oil for gold rather than dollars if they can take the dollars, buy gold themselves, and then everything will be fine? Well, the answer to that question is this. In the equation of what is the money in the situation, dollars or gold, the answer is the money is gold. Dollars are just a substitute for gold. Final paragraph here. Just as the German industrialist who built a successful business over a lifetime and outsourced only one thing to the German government, energy security, banks have been managing their paper gold books with one assumption, which is that states would ensure gold wouldn't come back as a settlement medium. Now, what is another word for settlement medium? That is money.
Oh, I like money.
Yeah.
How many billions?
It's 80, Frito. It's $80 billion. That's a mighty big minus, isn't it?
Yeah. I like money, though.
Lots of people in the gold and silver community, understandably, and I'm not really criticizing this, I'm just trying to clarify, believe that the paper markets are wagging the dog, that the paper markets are unfairly manipulating the gold price lower. That's not exactly what's happening. I'm not saying that there is no manipulation in the paper markets. There are, but I think it is minor compared to the fact that paper markets even exist. Why can paper gold markets exist? Because gold is not a settlement medium. It is not a money directly. Once it is, then the demand for physical gold expands globally everywhere to prices that are much higher, or exchange rates of the dollar that are much higher than the paper market can sustain. the price that you're looking at when you look at a paper price or the spot price or the futures price, that is the price for gold as a commodity, not as a money. For jewelry or for dental fillings or for electronics, etc., that price can clear the market for gold as a useful commodity, but not as a money. As long as gold is not a settlement medium, is not a money directly, that means the paper market can exist. The fact that gold is not a money directly is what enables the paper market to exist. It is not the paper market that enables gold not to be a money. That's cart before the horse, and it is the opposite of what is actually happening. Is the paper market a problem? Yes, but it is a problem because gold is not a money directly. It is not what makes gold not a money directly. It is the result of that. But once it is, all those shorts are closed and the paper price converges to the physical price, whatever that price is. If it's 100% backing of all Federal Reserve liabilities, it's about $30,000, $40,000, $45,000 an ounce, depending on exactly how big the balance sheet is at the time it happens. And that's not really a price so much as it is an exchange rate between a gold ounce and its substitute. And finally, the Federal Reserve continues to lose more and more money. And I'll show you exactly how this is happening. And that loss is plugged in by more money printing of literally unbacked dollars, which turn into what are called deferred assets, which are not backed by any assets on the Fed at all. And that is mechanically what leads to hyperinflation, at least from a balance sheet perspective. That's why we have this chart. This is the Fed's earnings or deficit. And you can see that since about 2010, 2011, earnings have almost always been positive. And so that extra income is remitted to the Treasury so they can spend it on whatever they want. And the earnings suddenly went negative here, and they continue to go down and down and down and down. They are now at negative $13,170,000,000, and that money has to be printed up.
We're in a hole. We're just gonna have to dig ourselves out.
And handed to who? How is this happening? Let's go to the next chart. I have here the interest rate on reserve balances. Reserve balances is all the dollar reserves that exist in the U.S. banking system. And as the Fed raises interest rates, these are all the hikes, the more interest they have to pay on these reserves. So we're currently at the level of 3.9%. And assuming we have a 50 basis point hike this week, we're going to go to about 4.4%. But how much money are they paying interest on? And we see that in this chart. This is, first of all, the reverse repurchase agreement, reverse repos that are in the banking system, $2.146 trillion. They have dropped a little bit, but they're still over $2 trillion. On all of this, they have to pay 3.9% interest annually. So that money they lose. And in addition to that $2.146 trillion, you have the actual reserves in the banking system. The reverse repos are over and above the reserves that exist that cannot be fit on the balance sheet, so they go back to the Fed in the form of reverse repos. But this is actual reserves in the banking system, and we are currently at 3.0557 trillion. So altogether, they have to pay 3.9% interest on over $5 trillion of reserves and reverse repos. That money they pay out, and the money that they get on their assets goes in, and there is a deficit of about $13 billion, which is going to get deeper and deeper the higher interest rates go.
Deeper and deeper, way down. Deeper and deeper, way down. Deeper and deeper, way down.
And we have this one. It's not just Russia that is abandoning the dollar for gold in terms of oil. Not doing it yet, but according to Zoltan, Pozsar could do it any minute now. China to use Shanghai exchange for yuan energy deals with Gulf nations. Xi, that's the president or king or whatever you want to call him of China, Winnie the Pooh. China's President Xi Jinping said in Riyadh on Friday that China and Gulf nations should make full use of the Shanghai Petroleum and National Gas Exchange as a platform to carry out yuan settlement of oil and gas trade. There's nothing more that you have to understand about that other than China wants to use its own exchange instead of the dollar to settle oil trades, which is the same as Russia saying we don't want to use the dollar, we'd rather use gold. So if both China and Russia are not using dollars to buy and sell oil, then the demand for the dollar plummets through the floor.
This is Sparta!
And the purchasing power of the dollar across the world for anything from bubblegum to bonds goes way, way down. Is this going to happen? Absolutely, it's going to happen. Exactly how it's going to happen, exactly when, we do not know, but I have the feeling it will be concurrent with the Fed's final pivot, which will have something to do with a crack up in the bond market. BlackRock smells it. They're saying that volatility will be worse than ever before. The mainstream smells it. Nobody knows what to do except trade more, but the gold bugs know what to do. That is, get money now before the substitute dies. This is Rafi of the Endgame Investor. If you enjoyed this video, consider subscribing to a 2-week free trial of the Endgame Investor. Or you can go to my Patreon on Patreon, where you'll get a weekly biblical commentary on monetary policy and economic policy topics. And for now, always remember, I will not comply.
Pop a poplar in your mouth when you come to Fishy Joe's. What they're made of is a mystery where they come from. No one knows. You can pick them, you can lick them, you can chew them, you can stick them. If you promise not to sue us, you can shove one up your nose.